This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on scalping. I'm going to begin by talking about entering with stop or limit orders, and then scalping in trading ranges and trends. And finally, I'll talk about bar sizes and time frames. Take a look at the chart on the left. The range is broad, and the bodies are mostly big. The bars do not overlap that much. And in a situation like this, traders can buy with stops, for example, above a bull bar near the bottom, micro double bottom here, failed breakout to new low, bull bar closing on its high, bull breakout, pullback, bull flag. The trader can also enter with limit orders. For example, buy the close of strong bull bars, or buy below a weak-looking sell signal. We have a reversal down that's strong, but a big tail on the bottom of this bar, and then a bull doji on the bottom of that bar. More likely buyers below its low than sellers. And then also buying closes on the way up. Buy a reversal down, betting that it's not going to be a successful reversal. A couple pretty good bull bars here, and the sell signal bar is only a doji, probably buyers below and at least a little bit more up. And the same is true on the downside. You can be selling with stops and reversals down from the top. And you can also sell with limit orders. You can sell the close. We have consecutive big bear bars, room to the bottom of the range. And you can also sell above bad bull flags. Here we have 3 consecutive bull bars, one big one closing on its low. And here a bull bar, yes, but a big tail and a big buy climax, 3 consecutive bull bars. Probably the best the bulls get is sideways, so bears will sell above that high. High to buy, but a big bear bar. Traders will sell above the high. Compare this to the chart on the right, where their tails are prominent and the reversals are coming every 1, 2, or 3 bars, and a lot of the bars overlap. In a situation like this, you have to make very quick decisions. Let's say this is a 5-minute chart. And most of the time, you'll be entering with limit orders, betting on reversals instead of on successful breakouts. And in general, you want to buy low, sell high, and scalp. A pair of bear bars, you want to sell above. A new high, breakout above 2 bear bars, you sell above. A bear bar here, does that look like a good buy? No, so probably more sellers here. A breakout above a high near the top of the range, probably sellers for a scalp down. Does this look like a good bull flag or a good buy signal bar? No, so bears will sell and sell more higher. So they'll enter with limit orders. A bull flag at the top, but 2 fairly prominent bear bars and a lot of trading range price action. More likely sellers above the high of this bar, especially since the bar has a fairly prominent tail. And also, the market's been sideways here for 4 or 5 bars. Bulls will buy with limit orders as well. They'll bet against successful downside breakouts. We have a big tail on the bottom of this bar. Tail on the bottom of this bar, is that a good-looking sell signal bar? Depending on what's to the left, traders might buy at the low of that bar. And is this a good-looking sell signal? It's a micro double top, but a big bull bar here. A lot of traders will buy that low and buy more lower. a big bear bar closing near the low. A lot of traders will buy that close, betting against the successful bear breakout. Traders will buy new lows, they'll buy below new lows, they'll buy bear closes. Here's the bear breakout, but the bears need a follow-through bar. A lot of bulls will buy that close, betting the bears will not get their follow-through bar. We go up for a few bars. For the bears, it's a bear flag, but the bottom of a market that has a lot of sideways trading. So bulls will buy that low. They'll buy the low every bar, prior bar. Here you get a big bear reversal bar, but tight trading range here, and the entire range is tight. Big bar, so big risk. Selling at the bottom of a tight trading range, so low probability. Even though it's a good-looking bear bar, the context is terrible. So big risk, low probability, more likely buyers below. Let me get rid of the stop orders and just talk a little bit about limit orders. I talk about stop order entries in other videos, like the videos on trading the open, and I'm not going to be talking about that here. I'm going to be concentrating on limit order trading here. Market orders are a type of limit order. You can argue a limit order is a type of market order. I'm just drawing the contrast with stop orders. I'm not talking about stop orders here. In the Forex markets, only about 25% of the days have reasonable swing trades. So if you're a Forex trader and a day trader, for the most part, you're going to be scalping. And a lot of your entries are going to be with limit orders. This is what a typical day looks like in the Forex markets on a 5-minute chart. So if you're going to be trading it, if you're going to be actively trading it, looking for many trades, most of your trades are going to be limit order scalps. 25% of the days you'll have reasonably good swing trades. But if you're a day trader, you're not looking to trade just 1 or 2 days a week. You're looking to trade every day. And if you're going to be doing that, you're going to be entering with a lot of limit orders. Look at this. This is a 60-minute chart of the euro versus the dollar. Clearly trending up, clearly trending down. And most traders make more money if they look for times when the market's doing that or that, and then swing trading. Swing trading is better for the vast majority of traders, but it only is easy to do when the market is clearly trending. So here we're in a pretty tight bull channel. We have a buy climax. We go sideways, lower high major trend reversal, and then a pretty tight bear channel. When it's doing this, you can buy at any point during the channel, stop down here. And when it's doing this, you can sell at any point, stop up here. An example, we have 3 consecutive bear bars closing below their midpoints or on their lows. We're getting lower highs and lower lows. So it's reasonable to sell. As soon as that bar closes, you just hit the button, sell the market. Or you can place a limit order to sell as soon as the bar closes, selling on the close. But you have to use the correct stop. So if you're buying here on this reversal up, we have 3 bull bars, the bodies are getting bigger, and it's following a bull reversal here. You buy, stop below the low. And then after you have a new breakup that's reasonably strong, you have a new major higher low, you raise your stop to here. And then here, the stop is still down here or here, but once you have a breakout, you raise your stop to here. On the way down, we have 3 strong bear bars. Even though it's not a new low, anyone selling from this point on, they'll probably put their stop above the top of this 3-bar sequence, because if it's in a bear trend, the market should not get above the top of this 3-bar bear breakout. And then down here, after you've had several bars down or new breakout, you lower your stop to here, the top of the most recent major lower high. And you keep your position on until there is a reasonable opposite signal. So if you're buying and you keep buying, if you buy at any point through here, you hold long until there's a reasonable opposite signal or a reasonable excuse to get out. Here we've got a bull channel, and we have a very big bull breakout, the biggest bull bar in 20, 30, 50 bars, and then a big bear reversal. Probably we're going to get a couple legs sideways to down, and it could lead to a bear trend. So most traders would get out below that low, betting on the reversal. And then here might be entering a tight trading range. We have a sell climax. Maybe it's the end of the session and you're looking for a reason to get out. This would be a good reason. We have a bull IOI with the bar closing on its high, reasonable to get out above the high of that bar. On this swing trade, if you bought here and exited here, you'd make 320 pips on the 60-minute chart in just a couple of days. And if you sold here, deciding that, yes, the breakout is strong, we're going at least a little bit lower. No good reason to get out here, no good reason to get out here. If you're looking to get out at the end of a session, this would be a good location, and you'd exit with 180 pips. Can you also scalp? Sure. When the market's in a tight channel like this, it's better if you're scalping only to scalp in the direction of the trend. One of the problems with scalping is if you buy and exit, it's really hard to get back in. Some traders are very skilled at this, so that they buy, exit, buy, exit, buy, exit, and they can re-enter repeatedly. They sell, maybe take profits, sell again, take profits, sell again, take profits. Most traders cannot do that, and because of that, most scalpers will not make as much money as swing traders when the market is trending. They end up missing too many trades. Scalping, by definition, has a small reward. You're going for a quick, small profit. And that means the risk reward is bad, because in general, your stop is fairly far away, and it's often greater than your risk. So you're taking a trade with a bad risk-reward profile. How can you possibly make money doing that? Well, most traders cannot consistently make money doing that. However, there are many who can. The only way they can is by carefully selecting trades that have very high probabilities. You have to have a very high probability to offset a bad risk reward. And as I said, if you're scalping here, you buy, you get out, a lot of times it'll be hard to get back in. There are ways that scalpers can increase their probability of making money. But anytime you increase your probability, what do you have to give up? You have to give up risk reward. So if you're doing something that will increase the probability of making money, you're going to reduce your risk reward profile. Usually it means increasing your risk. For example, you'll scale in. You'll add to your position, which means that you have more money at risk. You'll also, in general, have to use a fairly wide stop. It doesn't matter where you buy in here, your stop is down here. If you buy here, doesn't matter. Your stop is all the way down here. Pretty wide if you're just going to be scalping. So, for example, you buy here and you get a bull breakout or buy climax, you exit. You pull back, you start to reverse up again, you buy again, and you exit again with 50 pip profit. And you can just repeat the process all the way up. And on the way down, you can do the same thing. Okay? We're trying to reverse up. You have to bet the reversal will fail, so you sell. Or you sell the third consecutive bear close, closing on its low, looking for a scalp. And you exit with a 50 pip profit. And you can repeat the process all the way down. And on paper, you say, well, that looks pretty good. You know, I can end up with 6 scalps and make, or 7 scalps and make 350 pips. The reality is, most traders would not take all those trades. They'll take 1, 2, or 3, and they'll make far less money than a swing trader. Scalping in trading ranges is a very popular thing to do. You can also scalp in trends. 60-minute euro versus the dollar chart. And a lot of times, scalping is the only way to make money. And swing traders are not going to be making money. So if the market looks like this, a swing trader is not going to be making money, but a scalper can. The tighter the range, the less chance swing traders have to make money. And yes, a swing trader could say, big reversal down, failed breakout, expanding triangle, 1, 2, 3, double top. I'm going to sell, which is okay, looking for more down. And if he was still short here, he might stay short here, but you would have to sit through a trading range that can be 20, 30, 40 bars. And then here you get a reversal up. When you see this kind of price action, you're simply not going to be making much money as a swing trader. You're probably not going to be making money at all. Better to get flat, or if you're going to be trading, it's better only to scalp. Here we have a bear trend. We have a bull trend here. But let's look at this bear trend. A bear breakout, pullback, bear flag, another leg down, pullback, another leg down, pullback. But there's something about this that is important. It's a stairs pattern. We have a bear breakout. Here's the breakout point, and here's the pullback. And look what happened. The pullback rallied above the breakout point. And that's really important to notice in any kind of a trend. When that happens, I call it a stairs pattern. And we get a breakout to new low here, pull back above the breakout point. So we're stair stepping down. We got a breakout to a new low here. Ultimately, the pullback came back above that breakout point. Now, why is that important? Well, as a scalper, when I'm scalping, I really want to see that, because that tells me that I can start making money buying at the prior low and scaling in lower, betting that the market will come back above the breakout point. So once I see this, or once any trader starts to see this, they'll start buying new lows, scaling in lower, and then scalping out. Buying new lows, scaling in lower, and then scalping out. Once you start to see a stair pattern, gaps closing. We have a gap between this close and that low, but the gap closed. We have a big breakout bar, so a gap between this close and that low, and the gap closed again. As trends progress, they become weaker, and once channels become stairs, traders are expecting that the market will soon evolve into a trading range. As a result, bulls look to buy at the prior low. So we have a stairs pattern here. Bulls will bet that the next breakout will also be a stair, and the pullback will go above that low. Doesn't always happen, but it's a pretty reliable sign, especially late in the trend. You want to make sure that your second entry is at least as big as a scalp, because what you're trying to do is make a scalp profit on that second entry when it gets back up to the first entry. So you get out, break even on the first, and with a profit on the second. On the other hand, if the market immediately goes to your target, you don't have to scale in. Here we got a low. Bulls are going to buy the breakout, betting the breakout will fail. And it immediately reached their target, so therefore they did not have to scale in, they just take their profit. I talk a lot about this in other videos, for example, trading in tight bull channels, broad bull channels, tight bear channels, broad bear channels, trading in trading ranges, and then also in the videos on losing money because of mistakes. I think if you're thinking about scalping, you have to pay attention to the size of the bars. Also, the time frame is important. Compare this 5-minute chart of the E-mini with this 5-minute chart of the euro versus the dollar, a forex market. Most scalpers use charts that are 1 minute, 5 minutes, 15 minutes, somewhere in that range. In general, you're not going to be making money with 1-minute charts. When you see websites talking about that, you better move on, because you're not going to be making money doing what they're telling you to do. Now, this is a typical day in the E-mini, and the average bar is maybe 6 ticks tall, 10 ticks tall, somewhere in there. That's what happens on an average day. Now, why is that important? The minimum scalp size in the E-mini is 1 point. That means that most of the bars are bigger than the minimum scalp size. In fact, most of the bars are 50 to 100% bigger than the minimum scalp size. Now compare that to a 5-minute chart of the euro versus the dollar or any other forex market. On most days, the average bar is 6 to 10 pips tall. Now, why is that important? Because the minimum scalp in a forex market should be 10 pips. In other words, the average bar size in the forex market is smaller than the minimum scalp size. The average bar in the E-mini is bigger than the minimum scalp size. And the result is, if the average bar is bigger than the minimum scalp, you can scalp on almost every bar all day long. On the other hand, if the average bar is smaller than the minimum scalp, you have to go 2, 3, 4 bars to get a range that's big enough to make a scalp. So there are far fewer scalps on a 5-minute chart in the forex markets than there are in the E-mini market. However, some traders simply prefer trading the Forex markets, for a variety of reasons. First of all, you have much more flexibility over your position size, especially if you have a smaller account. A good trader is going to make money in any market. It does not matter if you prefer to scalp in Forex markets compared to the E-mini. You can also scalp on higher time frame charts in the Forex market. Again, this is a 5-minute chart of the euro versus the dollar. And on the right, I'm going to put up a 60-minute chart in a minute. Now, you need at least a 10 pip target, profit target, to make scalping. That's the absolute minimum you need to do to consistently make money as a scalper. If you try scalping for only 3 pips or 5 pips, you almost certainly will lose money. It's a lot easier to make money when many of the bars are bigger than the minimum scalp size. Here, most of the bars are only 4 to 6 pips tall, and it's just really hard to make money. This whole range is only 10 pips tall. How are you going to make the minimum scalp of 10 pips? Really, really difficult. On the other hand, look at the 60-minute chart and on many 15-minute charts. Many of the bars are more than 10 pips tall, so many of them are more than a minimum scalp size, and that makes it easier to make money. Buying a reversal up here, buying a reversal up here, 2 legs down, 1 pullback 2, and a trading range, micro double bottom, down and up on that bar, down on this bar, up on that bar, so reasonable to scalp. Should you be scalping for 10 pips on a 60-minute chart? Rarely you should ever do that. However, you can often scalp for 50 pips on a 60-minute chart or on a 2-hour chart or a 3 or 4-hour chart. All right, on the left here, I have a 5-minute chart, euro versus the dollar, and this blue box here is right here on the 1-minute chart. So this 1-minute chart is this segment of the 5-minute chart. We have a higher low, decent reversal up, probably either a trading range or a higher low major trend reversal, a pair of bull bars, reasonable to buy with the stop above the high of that bull bar, betting on at least a scalp up. You can look for an earlier entry on the 1-minute chart. Remember, this right here is the part in blue right here. So you're already expecting some kind of reversal up, some kind of a double bottom. So you can go to a 1-minute chart and see if you can get in earlier. On the 1-minute chart, you see 3 pushes down, 1, 2, 3. You do not see that on the 5-minute chart. You also see a triangle, possible final flag late in a bull trend. And then you have a decent buy signal bar at the bottom of the channel after a potential final flag. Since you're looking to buy on the 5-minute chart anyway, you can look at the 1-minute chart and get an earlier entry. If you do that, your entry is 8 pips lower than on the 5-minute chart. This entry on the 1-minute chart is 8 pips below the entry on the 5-minute chart. Here's the entry on the 5-minute chart. And this, if you buy here, it's on the 1-minute chart, 8 pips lower. In general, should you do this? No. But if you become an experienced trader and you're really good at reading the 5-minute chart and in anticipating a trade, then you can look at the 1-minute chart and try to find an earlier entry. 1 minute chart, it looks easy, but it happens much faster than you think, and it's just really easy to make a lot of mistakes. So you're entering on the 1 minute chart trying to have better risk reward. Your risk is less, your stop is closer, your reward is greater, you're buying lower. But you're going to pay for it with lower probability. Part of the reason for the lower probability is that you'll make more mistakes, so the chance of making money is less. As a result, a 1 minute chart is less reliable than a 5 minute chart. Things can change very quickly. We're down here, and 1 minute later, a couple minutes later, we're up here. Sometimes the changes take place in just a matter of a second. A lot of times in the final second of a 5 minute bar, sometimes in the final second of a 60-minute bar, very commonly in the final second of a 1 minute bar, institutions will do something to make the bar look very different than it did a second or so before. So you can get big surprises that happen right before the bar closes. See this bar here? I don't know. It was possible that it was just a little doji bar, and then in the final second collapsed and did that. And then you have to reevaluate what you're doing. You're being forced to make a quick decision. What often happens is you place orders quickly, and then you decide you made a mistake. You end up taking a small loss. You end up entering a couple ticks worse than what you intended, and the institutions will end up taking your money because you made a very quick decision and you just did not have enough time to make the decision as well as you would like to do it. So as a result, the institutions will be taking your money. In general, you're not going to be making consistent money if you're trading any chart that has more than about 20 bars an hour. In other words, maybe a 3-minute chart, you're probably better off trading a 5-minute chart, 15-minute chart. If you trade some other type of chart, like a tick chart or a volume chart, this trader should not be trading on any chart that has more than 20 bars per hour. I think most traders should avoid looking at 1-minute charts, especially beginners. It looks really, really easy. And beginners focus on risk. I don't want to lose too much money, and therefore the 1-minute chart is great. The bars are small, so my stop is close. But it doesn't matter if you're not losing much money on any one trade. If you're losing on a lot of trades, all those little losses become a big loss by the end of the day. Another problem that beginners have is they don't use stops that are wide enough. For example, let's take a look at over here. He ends up also taking low probability trades. You got a bull reversal bar here, possible final flag. He buys here. He sees a wedge bottom maybe. However, he ignores the fact that it's a wedge bottom, but the channel is extremely tight. So therefore the reversal up is probably minor, maybe a pip or so, and then failed. So yes, you do not lose much money, but you lose often and all day long. Remember, this is a pullback in a bull trend. And here you are buying in a bull trend above a bar, and then you're immediately getting stopped out right below the bar with a 4-pip loss. So here you are buying in a bull trend. Remember the 5-minute chart. This is the 1-minute chart. The 5-minute chart, this is in the process of creating a bottom. So you're buying a bull trend and you're losing money. Expert trader, he would not take that trade unless he was willing to use a wide stop. And that defeats the purpose of trading on the 1-minute chart. One of the reasons you're trading the 1-minute chart is to use a very tight stop. Expert trader, if he takes that buy, he's using a wider stop, maybe a measured move down, below a measured move down, and he's going to be scaling in. He'll buy more lower instead of getting out with a loss. And that's, I think, unreasonable to expect a beginner to be able to do. I mentioned that in the Forex market, it's better only to scalp for at least 10 pips. Look at this bar, this box right here. I'm using it as a ruler, a measuring stick. That's 10 pips tall. Look at the bars on this chart. Only 2 bars on the entire chart. There are over 100 bars in this chart. Only 2 of them have a range that is 10 pips tall. And the entire range of this 100 bars is only 35 pips. And that's very common in a session in the Forex market for the range to be 30 pips all day or all session. Now, think about it. If most of the bars are smaller than 10 pips and you're trying to make 10 pips, it's really difficult to make a living as a scalper. And if you're deciding that you're going to go for a reward less than 10 pips, I seriously doubt that you'll make money. And one of the problems with going for smaller targets is that the spread becomes disproportionately too big, and you end up having to win 90% of more of your trades to make money, and that's just not realistic. Great scalpers do win 90% of their trades, but those traders, a lot of them are using wide stops and scaling in, and that's not something that a beginner should ever consider. They will lose money. And you will lose money if you're going for a reward less than 10 pips. And in fact, most traders will lose money even going for a reward that is 10 pips tall. That's the minimum scalp. Here, 99% of the bars, 95% of the bars are less than 10 pips tall. The entire range during this session is only 30 pips or so. You're not going to make money. Certainly here, you got 3 or 4 hours where the range is 20 or 30 pips. You're not going to make money. So what do? Well, one thing you do is you do not trade. If you're in an environment where you're going to lose money, you should not trade. All right, so let's do this again. Okay, use this as a measuring stick. This is 10 pips tall. And look at this chart. This is different from that last chart. There are a couple things different about it. First of all, you have 8 bars on this chart where the range of the bar was 10 pips tall or greater. And the entire range from the bottom to the top is 50 pips. The other chart, it was 30 pips. This chart, you have a better chance of making money. Here, we have 8 bars with a range of 10 pips. We have an entire day's range of about 50 pips. If you're looking to scalp in a Forex market, you need a range like this. You need legs that are 20, 30 pips tall, entire range 50 pips or more, and you need to see several bars that are 10 pips tall. So this is pretty much the minimum that you need to be scalping for 10 pips. you need a range of about 50 pips, and you need a lot of the bars being 10 pips tall. I began by talking about stop or limit orders, and then I moved on to talking about scalping in trading ranges and in trends. In general, if the market's in a trend, you have a far better chance of making money as a swing trader and making more money as a swing trader. And then finally, I talked about bar sizes and time frames. Traders should not be trading the 1-minute chart. And if they're scalping, it's easier to make money if the average bar size is at least as big as the minimum scalp. So if you're scalping in the Forex market for 10 pips, it's better if you have a lot of bars on the chart that are at least 10 pips tall. And it's better if the range is at least 3 or 4 times bigger than the minimum scalp. So you want at least 30, 40, 50 pip range in the Forex market. I'm Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 4 videos on scalping.